Iron Financial. We're the only place that puts companies through a full structural analysis to see if they're built to last, or if they're built to fail. Our mission is simple: to help you forge a stronger portfolio. Today, the company under the microscope is Amphenol. Now, they just dropped a set of earnings that aren't just good, they are absolutely record-shattering. And that brings up the big question: are these numbers solid steel, or are they just hiding deep cracks under the surface? I'm your lead analyst. Let's get to work.
So let's just jump right into the one number that is turning every single head on Wall Street: 52%. That is the full year sales growth. I want you to just let that sink in for a second. In this economy, for a company of this size and scale, a number like that is an absolute pure show of force. It's a statement. It's telling you that something truly massive is happening inside this company. I mean, think about it. Most of their competitors would do anything for just a quarter of that growth. Amphenol did it for an entire year. Whoa, hold on a second. Video game numbers is exactly right. But you know what? That's the problem. Anytime you see a number that looks that good, that almost looks too good to be true, you have to start asking the hard questions. You have to put on your skeptic's hat. Is this real sustainable strength, or is this just a sugar high that's been fueled by a mountain of debt and a string of acquisitions? That's what we're here to find out. Is the foundation truly solid, or is it just a beautiful facade built on pure hype? That's exactly right. And to get to the bottom of it, we're not just going to glance at the numbers. We're going to execute a full structural inspection. Here's our blueprint for today. First, we'll examine those headline numbers. We've got to see if there's real strength behind them. Then, we are going to deconstruct where that explosive sales growth is really coming from. After that, we'll stress test their profitability. And then we're going to put the entire financial foundation, I'm talking about the balance sheet, under some serious pressure. And finally, we'll finish by taking a hard look at their plans for the future before we deliver our final iron verdict. Let's get started.
All right, let's get into it. Section 1, record numbers, real strength. Look, before we start digging around trying to find cracks in the foundation, let's just take a moment to look at the sheer force of these results. This is what I'd call the initial shock and awe campaign, pulled straight from their press release. What this really shows is the incredible consistency of this blowout quarter. It's not just one flashy metric. Look at this. Q4 sales shot up 49% to $6.4 billion. Full year sales, as we know, up 52% to over $23 billion. This isn't just about beating expectations. This is about completely rewriting them. And here's the best part. It's flowing directly to the bottom line. Adjusted diluted earnings per share for the quarter is up 76%. For the full year, it's up 77%. Now, whenever you see earnings growing faster than sales, that signals incredible operating leverage. It means that every single additional dollar of sales is generating more and more profit. That's the sign of a highly efficient, well-oiled machine. And on top of all that, they're returning $1.5 billion to shareholders. I mean, if that doesn't scream confidence, I don't know what does. It's supreme confidence. The CEO, Adam Norwitt, isn't just coming out and saying they had a good quarter. He is explicitly stating that they blew past the high end of their own already optimistic guidance. This is management taking a well-deserved victory lap. They went out, they promised a strong performance, and they came back and delivered a legendary one. For anyone bullish on this company, this quote is all the confirmation they need that Amphenol is firing on every single cylinder. Okay, so the headline numbers are massive, I'll give them that. But a number like 52% growth, it demands a much deeper look. You just don't get there by accident. So in this section, we're moving past the headlines, we're forging into the core of the business to ask the question, where exactly is this explosive growth coming from? You know, it's one thing to hear the percentage, it's another thing entirely to see it visually. Just look at this. In 2024, they posted $15.2 billion in sales, a respectable number. But in 2025, they did $23.1 billion. That is an almost $8 billion jump in a single year. That isn't just incremental growth, that is a fundamental step change in the size and the scale of this entire company. The sheer verticality of that second bar, that tells the entire story in one single image. And that brings us right to the crucial question. The million-dollar question, or I guess in this case, the $8 billion question. 52% is a massive number. It gets headlines, it gets attention. But as investors, we have to be skeptical. We have to ask how much of that was just them opening up the corporate checkbook and buying other companies' revenue streams, and how much of it was their core business actually firing on all cylinders. In other words, how much of that growth did they buy versus how much did they actually earn? That's the difference between a solid foundation and a house of cards.
That is the single most important question you could ask about this company right now, and this is where we get a crystal clear answer. This is where the truth lies. The headline number, that 52%, is right there at the top. But look at how it breaks down. Acquisitions contributed a very significant 13%. You absolutely cannot ignore that. That's some heavy lifting. But the crucial point, the one that really matters, is the number at the very bottom. 38% organic net sales growth. Let me say that again, 38%. If you took away every single acquisition they made last year, their core underlying business still grew by a staggering 38%. That is elite-level performance in any industry, period. It tells you that the engine itself is incredibly powerful. The acquisitions are just the afterburners.
So let's drill down just one level deeper. We can see here their sales broken down by segment for the fourth quarter. And you can see that Communication Solutions is the absolute giant here, making up 53% of the business at $3.4 billion. But here's the real kicker. Buried in the press release, it states that the Communication Solutions segment itself grew by an insane 78% in the quarter, and even more remarkably, 60% of that growth was organic. So this isn't just broad-based strength. It's being led by a dominant hypergrowth engine in their biggest division, and you have to assume that's being driven by the massive demand from IT, Datacom, and of course the AI infrastructure markets.
Okay, so the top-line growth is absolutely immense, and most critically, it's largely organic. That's a massive check in the bull column. But as we all know, big sales numbers are just vanity if they don't translate into actual profit. So for our third inspection point, we're examining the bottom line. Is Amphenol a profitability powerhouse, or is all of this incredible growth coming at the expense of their margins? At first glance, the initial numbers look incredibly strong. GAAP EPS of 93 cents, adjusted EPS of 97 cents. Both of those are showing massive year-over-year growth. But hold on a minute. Whenever I see two sets of books, one for GAAP and one adjusted, my skeptic alarm starts going off. It's that 4-cent gap. Now, it's not huge, but it's there. So what exactly are they adjusting out of their numbers? What are they asking us, the investors, to simply ignore?
Let's pull back the curtain and see what's going on. These adjustments really boil down to three main items for the fourth quarter. First, you've got about 3 cents per share in acquisition-related expenses. That's just the cost of doing deals, banker fees, lawyer fees. That makes perfect sense given their aggressive strategy. Then they get a 7-cent benefit from some stock compensation tax rules. But the one that really catches my eye is the last one, an 8-cent per share hit from a discrete tax item. Now, if you dig into the footnotes, you find out this is a $100 million accrual because Chinese tax authorities are challenging their tax positions over there. Now, that's not just an accounting entry. That is a real risk. This is the first potential stress crack we've seen in the foundation. It's absolutely a risk, and it's one we have to watch. But with those adjustments in mind, let's look at the real measure of operational strength, the operating margin. The adjusted operating margin strips out those non-core items to give us a clean, unobstructed look at the profitability of the business itself. And the number is a monster. Their GAAP margin was already an excellent 26.8%, but their adjusted core operating margin was 27.5%. To put that in perspective, that is an elite, world-class number that most industrial manufacturers can only dream of achieving. It tells us that despite all the complexities of acquisitions and tax issues, the core operational machine at Amphenol is incredibly efficient and profitable. They aren't just growing, they are growing with tremendous discipline. Fine, I'll admit, the income statement is solid. The top-line growth is real, and the bottom-line profitability is elite. But an income statement is just a snapshot in time. A company can look profitable right up until the moment it completely collapses because its financial foundation is rotten from the inside out. So now we move to what I think is the most important test of all, the balance sheet and the cash flow. Can the structure actually support the incredible weight of this explosive growth, or is it leveraged to the absolute breaking point?
First things first, let's look at the first pillar of any strong foundation, cash. At the end of 2025, Amphenol was sitting on a mountain of $11.1 billion in cash and cash equivalents. That is a massive war chest. It provides flexibility, it provides security, and it gives them the firepower to continue executing their aggressive strategy. This is the ultimate defense against any market uncertainty that might be coming down the pike. A war chest? Sure, but it came at a very steep price. Let's not forget to look at the other side of the ledger. To build that cash pile and to fund all of those acquisitions, they took on a heavy, heavy load. Just look at the total debt. $15.5 billion. That's nearly $1 billion in current debt that's due soon and another $14.5 billion in long-term obligations. This is the direct consequence of an aggressive acquisition strategy. You don't get 13% inorganic growth for free. You pay for it with debt, and that debt creates its own risks and its own interest payments that weigh on the entire structure. And that debt load would absolutely be a major red flag if it were not for this number. This is the counterargument. This is the load-bearing pillar that supports everything else. $4.4 billion in free cash flow for the year. For anyone who's unfamiliar, free cash flow is the actual real cash a company generates after paying for all of its operations and all of its capital investments. It's the money that's left over that can be used for anything, paying down that debt, rewarding shareholders, or funding new growth. This powerful cash flow is what allows them to comfortably service their debt, pay dividends, and continue funding future acquisitions. This is the sign of a truly fortified financial foundation. So, the foundation is strong. It's being supported by a massive cash flow engine. This brings us to our fifth section. How are they using that incredible strength to build for the future? You see, a great company doesn't just report great numbers today, it invests today to ensure that it can report even better numbers tomorrow. So let's analyze their acquisition strategy and their guidance for what's coming next. This right here shows the sheer scale of their ambition. They completed 5 acquisitions in 2025, including Truxon. But the main event, the real headline grabber, is the deal they closed just after the year ended, buying CommScope's CCS business. And look at the impact. They expect this single acquisition to bolt on approximately $4.1 billion in new sales in 2026. They're not just making small tuck-in acquisitions here and there. They are buying entire market segments. This is an aggressive, forward-looking strategy that's designed to build an unassailable market position. And that aggression is reflected directly in their guidance. They're telling the market to expect 43 to 45% sales growth in the very next quarter, and 44 to 48% growth in adjusted earnings. Now, these are staggering numbers, but it raises a really critical question. Is this sustainable? Are they setting expectations so incredibly high that any small slip-up, any minor difficulty in integrating this massive new business is going to be seen as a catastrophic failure? The execution risk here is enormous. They've built the machine, but now they have to prove that they can run it at this speed without it completely breaking down. And this quote from the CEO gives us the strategic why behind the what of their actions. Norrit frames this entire growth story not as some kind of financial exercise, but as a strategic response to a fundamental shift in technology, what he calls a revolution in electronics. He's basically arguing that they have to be this aggressive to capture the opportunities that are being created by new innovations across all of their markets. So from their perspective, this isn't just about getting bigger for the sake of it. It's about positioning Amphenol to be the indispensable supplier for the next generation of technology. It's a very bold vision, and it's one that justifies these aggressive moves. We've run the tests. We've analyzed the top line, the bottom line, the balance sheet, and the roadmap for the future. We've identified the massive structural supports holding this company up, and we've pointed out the potential stress points. Now it's time to bring it all together and deliver the final analysis. It's time for the iron verdict. So the crucial point here is how you weigh these different factors. On the bull side, the supports are just immense. You have record-shattering 38% organic growth and a $4.4 billion free cash flow engine. That is undeniable fundamental strength. But the bear case highlights some very real stress points. The headline growth number is heavily juiced by acquisitions, and that strategy has loaded the balance sheet with over $15 billion in debt. And yet you also have a dominant market position that's being reinforced by these acquisitions, all while the company's maintaining elite 27.5% adjusted operating margins. True, but there are very clear risks on the horizon. That $100 million tax issue in China could easily get worse. And the challenge of smoothly integrating a $4 billion business like CCS is a massive execution test. After weighing all the evidence, our iron verdict is clear. This is a high-strength opportunity. The potential stress points you've highlighted, the debt, the acquisition risk, that China tax issue, they are real. We don't ignore them. But we believe they are more than supported by the company's fundamental strengths. The foundation of this company is not hype. It is solid steel, forged from a powerful free cash flow engine and elite operational execution. Their growth strategy is aggressive, yes, but it is also strategic. And most importantly, it's being funded by a core business that is performing at an absolutely world-class level. The numbers prove the structure can handle the weight. But let's be absolutely clear here. The verdict is positive today, but the hard work is just beginning. Amphenol has proven, beyond a shadow of a doubt, that it can build a titan of industry. The blueprints are sound and the materials are strong. But with the massive integration of the CommScope CCS business now underway, the single biggest stress test in the company's entire history begins right now. The question investors should be asking is no longer, can they build it, but can they operate it at this scale without a single crack appearing in that foundation? That is the story to watch in 2026.